All right, let's talk about corporate taxes. Specifically, let's talk about one of the trickiest parts. What does a company do when its tax bill isn't a simple calculation, but a giant complicated puzzle? Well, today we're going to decode the official rulebook for that puzzle, IFRIC 23. Let's jump right in.
So, here's our roadmap for today. We'll start with the problem itself, what happens when tax law gets fuzzy. Then we'll meet our guide, IFRIC 23, and walk through its 4 core questions. After that, we'll get into the nitty-gritty of how you actually measure this uncertainty, how you deal with new information as it comes in, and, most importantly, why this all matters to you.
Okay, first things first, the problem. Every single business has to deal with tax laws, but, these laws aren't always a straight line. Sometimes they're more like a tangled mess.
So, I want you to picture this. Your company does something smart, something strategic, but the tax implications, they're a bit of a gray area. It's not clear how the tax authorities are going to see it. So what do? Do you hope for the best, plan for the worst? This is the exact puzzle that businesses are trying to solve every single day.
And this puzzle, it actually has a formal name. It's called an uncertain tax treatment. It's really just any tax position a company takes where there's a real question mark over whether the tax authority is going to sign off on it. And this is the exact issue IFRIC 23 was built to address.
And this kind of uncertainty pops up in places you might not expect. We're not just talking about some super complex tax shelter. I mean, look at these examples. Something as basic as deciding whether or not you even need to file a tax return in another country can be an uncertain tax treatment if there's any doubt about it.
Okay, so we've got this puzzle of uncertainty. How do we solve it? Well, this is where our hero, IFRIC 23, enters the scene. It was put together by the International Accounting Standards Board to bring some much-needed clarity to all this chaos.
Before this standard really came into play around 2019, it was kind of the Wild West. Companies had all sorts of different ways of dealing with tax uncertainty. IFRIC 23 put an end to that. It created one consistent framework, making sure everybody plays by the same rules, which, of course, makes financial statements a whole lot more trustworthy.
So how does this thing actually work? Well, what's great about it is that it's not just a dry formula. It actually walks you through a logical process by making you answer 4 fundamental questions.
First, you have to decide, are you going to look at each uncertain position on its own, or does it make more sense to group them together? Next, and this is a big one, you have to think about what to assume about a tax audit. Then you get down to the numbers and figure out the financial impact. And finally, you have to be ready to change your assessment when new information comes to light.
Let's just pause on that second step for a moment, because this is really the beating heart of the entire standard. There's no crossing your fingers and hoping for the best. A company has to work under the assumption that the tax authorities are going to come knocking.
And the standard is crystal clear on this point. I mean, just read the quote. You have to assume the tax authority will examine amounts and have full knowledge of all related info. Wow. In other words, you have to report your position as if the auditor not only shows up, but shows up knowing literally everything. There is no hiding.
Okay, so you've accepted that an audit is coming. Now for the really practical part. How in the world do you put a dollar value on a maybe?
Well, the first step is a probability check. The standard says if it's probable, and in the world of accounting that means more likely than not, that your tax position will be accepted, you're fine. You can just account for it the way you filed it. But if it's not probable, that's when you have to get to work and actually reflect the potential financial hit of that uncertainty.
So, if you've decided acceptance isn't probable, the standard gives you 2 tools to measure the impact. For a really simple yes or no kind of outcome, you use what's called the most likely amount. But if there's a whole range of different ways things could shake out, you use a more sophisticated method called the expected value.
Let's actually see how that expected value method works. It's pretty cool. You just weigh each possible outcome by how likely it is to happen. So in this case, there's a 30% shot you pay nothing extra, a 50% chance you'll owe 50 grand, and a 20% chance of a big bill, 120 grand. You just multiply each one out, add them all up, and boom, the company needs to account for a potential tax hit of $49,000.
Now, here's a crucial point. This whole calculation isn't something you do once and then forget about. Not at all. Tax situations change, and IFRIC 23 demands that companies keep their numbers fresh.
This timeline here shows you exactly what I mean. Imagine you make your best guess in the first quarter. But then, in the third quarter, a court makes a ruling on a similar case for a totally different company. Well, guess what? That ruling is new information. You can't just ignore it. By the end of the year, you have to go back and reassess your own situation based on this new reality.
And the standard is very specific about the kinds of things that can trigger one of these reassessments. It could be a court case, sure, but it could also be new tax laws, or even just the time limit for an audit finally running out. Anything that changes the facts on the ground.
Okay, so we've been pretty deep in the weeds with the mechanics of this thing. Let's pull back and ask the big question. Why should we care? Why go through all this trouble?
Well, when you boil it all down, this standard gives us 3 enormous benefits. First, consistency. It makes sure every company is using the same playbook. Second, transparency. It drags those hidden tax risks out into the daylight for everyone to see. And those 2 things lead to the holy grail, comparability. It lets you actually compare the financial health of 2 different companies on an apples-to-apples basis. For an investor, that is pure gold.
And that's really the whole point of any good accounting rule, isn't it? It's all about making sure the numbers on the page are a faithful representation of what's actually going on. IFRIC 23 makes sure potential tax problems aren't just swept under the rug, but are measured and reported honestly.
So there you have it. That's IFRC 23. It's a powerful rule designed to bring light to the gray areas of tax law and give us all a much clearer picture. So the next time you're flipping through a financial report, you'll know what to look for. You'll know to ask, what tax puzzles are they trying to solve, and how are they telling us about them? Thanks for diving in with me today.